Greece is close to the line, but the outcome too close to call. Roshan Padamadan is founder and fund manager at Luminance Global Fund. He joins us from Singapore. Too close to call. So how are you playing this out for where you put your money?
Hi, Angie. Good morning. For Greece, the best option is not to put any money in because it depends too much on negotiations over the next few days. So the Greek banks, a lot of them have, like most banks, the loans to deposits are greater than 100. So they're living on day-to-day funding because money is being pulled out of the Greek banks every day. So the European Central Bank put in some money on Friday. That's just enough to cover about 1 day's withdrawals at the current rates. 1.75 billion is just about, it's probably what will get withdrawn today, Monday. So there is a slow-moving bank run. This might actually preclude some negotiations if this goes on. And the ECB funding was just enough for a day. So the negotiations are very vital. They need to resolve it kind of today because the medicine is being given only day by day. So it's quite a precarious situation right now.
And the patient is very close to critical. Well, it's beyond critical now. But Roshan, do you still put money in global equities, or are you just saying, let's just chill it out for this week? What are you being European specific or global?
I don't have much in Europe. I think my biggest overweight is Brazil. For most of the rest of the world, I prefer to be market neutral wherever possible. So I do some capital structure arbitrage, going long some shares, short some mispriced warrants, or vice versa. I construct some pair trades around a particular sector or a corporate spin-off. So market neutral strategies might be the way to go for the rest of the year, in my view. Any beta plays could be very risky, especially any Chinese beta. It's a very risky game if you think you'll make money in a greater fool kind of a situation.
Well, I wanted to ask you about China because the thing is, it has been incredible growth there. I mean, if you were predicting 10% rise, you were pretty much a bear considering that the Shanghai Composite has risen more than 150%. But what of this bubble? What do you think could happen if it bursts?
I mean, essentially, it's a policy-driven bubble. The economic growth is slowing down. We just saw that China steel output is coming down. Property growth is going to come down. So all these are actually pointing to a slowdown. But trying to fight that with a margin fuel bubble is probably not the right way to go. If a lot of people lose a significant part of their savings at age 25, 30, etc., they may not come back to the stock markets for another 10 years. They will be like, oh, this is a casino. And that's the bigger impact, I'm worried. So many new accounts are being created, millions of accounts created in the last few months. And these people, if they have a really bad experience, which they're very likely to, because when they try to book profits, they will find that not all of them will be able to book profits because it's a self-fulfilling prophecy. You need to have somebody to take the other side of the trade, and the markets will fall probably with the new set of IPOs coming in. And as people try to book profits, they'll find out that there's nobody on the other side of the trade. So that's where I'm worried about, that this might actually change the psyche of the Chinese stock investor for a considerable period of time.
Well, and certainly rob the equity markets of liquidity for a generation. Roshan Padamadan, thank you so much for that interesting point you're making there. Luminance Global Fund founder and fund manager.